Hin Leong was one of the larger oil traders in Asia, and its downfall has sent shockwaves through the global banking sector. Some 23 banks are owed about $3.85 billion US. According to Singapore media and wire agencies, HSBC is said to be its largest creditor, while Singapore's DBS, OCBC and UOB reportedly have total exposure of about $600 million US.
The collapse of that trader is certainly unpleasant, but the banks have very large balance sheets. And in terms of materiality, if they end up provisioning 100% of the exposure, this is only 3 to 5% of their pre-provision income for last year. So this is manageable. But I think the bigger question is not what already happened with that trader, but is there more such exposures that might be at risk going forward? And certainly the risks are on the downside.
The troubles at Hin Leong bring back memories of the oil price meltdown in 2016. Since then, the banks have stepped up their scrutiny of the sector.
The last time oil prices collapsed, the Singaporean banks were hit with large impairments, particularly for things like offshore marine sector. And what happened since then is that those books, offshore marine, has been extensively cleaned up. The rest of the energy exposures would be to the bigger refiners, to the bigger national oil companies, if you will. So, and with government linkages in a lot of the cases. So as a result, we don't expect a lot of impairment from there.
They're now cutting their exposure even further, particularly to speculative segments like oil trading.
A couple of the bankers, without taking names that I spoke to, they have said they have already started tightening. Letters of credit, short-term credit are being tightened. Institutions are saying, I need way more collateral and way more liquidity, as a fallback.
Besides the challenging credit environment in oil and gas, some of the loans to other sectors are also expected to go sour. In anticipation, the big three Singapore banks have bumped up provisions for bad debts. The increase in credit charges contributed to a drop in their first quarter profits. It's a similar trend among their US and European counterparts. The 5 biggest lenders in the US alone have built up a whopping $24 billion US in reserves to prepare for a wave of defaults.
As the economic impact starts to be felt across the economy, I think the banks will definitely be able to better grasp the potential impact they could have on the loan exposures and therefore make the necessary charges to their provisioning. So I think this will be a continuous revision over time, at least until we have an effective way to combat the whole virus situation. So right now, it is looking like the heavy impact will be felt for at least the next 2 quarters.
Ratings agency Moody's, however, thinks that the peak in provisions will probably only happen next year.
We do expect that more problematic loans will appear on the bank's balance sheets this year and next. We are concerned about SME exposures because SMEs typically have weaker financial flexibility. We also are watching the unsecured retail loans because typically those loans are more sensitive to people losing their employment.
To mitigate the impact for small businesses, the Singapore government has rolled out a series of support measures. This includes raising government's risk share of loans to 90% and providing lower cost funding to banks so that they can lend at lower interest rates to SMEs. SMEs can also apply to defer principal repayment of their loans until the end of this year.
What happens with those restructured and renegotiated exposures which benefit from regulatory forbearance? Again, most regulators in the world have allowed this forbearance or debt repayment holidays, if you will, up until the end of this year, right? And maybe that could be extended. Who knows? So the question is, what happens with those renegotiated or restructured exposures once those government support measures are lifted? What part of those would end up in financial difficulties, and what part will survive?
Even as the prospect of big credit charges loom, margins are getting compressed. Monetary easing by the world's central banks has led to lower interest rates, and that is putting further downward pressure on the bank's net interest margins. Banks take in deposits and lend out the money. The net interest margin is the difference between the interest the banks earn from their loan books and the interest they pay depositors.
We are seeing in the first quarter for NIM data is that it isn't really fully reflective of the margin pressures that we're seeing because of the interest rate cuts by the Fed during March itself. Only 1 month of impact has been felt by the banks, and what we have seen is that there is some resilience showing up in our local lending rates through the SIBOR and the SOR. So moving forward, we are likely to see more impact of the NIM starting to cascade down. NIM should continue to dip by at least about 10 basis points across the board for local lenders for the entire financial year 2020.
Faced with a double whammy to their main business of lending, observers say the banks have diversified into other sources of income.
The bank is not lending. Where are they making money? My deposits are still there, and the bank still needs to give me that 1.2% or 1.3%. How are they making that net interest margin? That's coming from transaction, from payments. It's not the fight for net interest margin anymore. It's the fight for transactions. And that's where the banks are seeing a little bit of more revenue come through.
In the first quarter, non-interest income for all 3 Singapore banks made up slightly more than 30% of total income.